T-minus 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, 0.
Okay, traders, I hope you are well. In this lesson, we're going to cover price delivery, trends, swing points, the importance of top-down analysis, and the fractal nature of the market. So looking at the first of the five, we have price delivery. There's really four ways that price is ever delivered in this market. The first way, in no particular order, you will have price delivered to you in a range or a consolidation. It will look something like this, where price is moving up and down, but it's generally respecting a high and a low of the range. The second way that price is delivered is you will have an expansion. An expansion is when price has been ranging or consolidating, and we'll say for this example, we get an expansion to the downside. When price is covering ground or moving a distance, you can consider this an expansion. The third way that price is delivered is a retracement. And this typically occurs after an expansion out of a range. Price will hit a particular point, it will turn and retrace some distance, and then it may continue in the direction it was going. The fourth way that price is delivered is a reversal. So you may have an expansion to the downside, and when we enter this retracement phase, instead of price turning and retracing and then continuing down lower, what ends up happening is it reverses and goes the other direction. Whenever you're looking at price, you have to ask yourself, what is price delivery doing at this moment in time? Are we ranging? Are we expanding? Are we retracing? Or are we potentially reversing? And there are ways to know and figure out exactly what's going on for the most part, or have very high odds at being correct. But again, we're going to cover all those things later. So there you have it, the four ways that price is delivered. Now that we know this and we understand this, we're going to take a look at trends. What trends are in the marketplace is a way to label the idea of price either moving bullish or in an upward direction over an expanded period of time, or if you have a bearish trend where price is moving down over an extended period of time. The way that trends are defined is through market structure. Because price has to execute what they call fair dealing, and it has to speculate, you're always going to have buyers and you're always going to have sellers. So the price is always going to move up and down as it travels. Whether you're bullish or bearish, there will always be equally buys and sells offered at all times, unless orders are skipped, which again, we'll go into that in a different lesson. The way that a trend is identified is by taking swing points, which we're going to cover next, and how to identify, where price turns, and monitoring and watching what happens at those points. In this bullish trend, these points here on the top, these are all considered higher highs because the point previously is being violated in what we call a break of structure. And how the break of structure looks, if you draw a line out right here, as soon as price passes above that, you have a break of structure. So here, here, and here. These are all breaks of structures. On the bottom side of this trend, we have higher low because this low is higher than this low. And if we were to draw a line out from these lows, you will notice that these lows are respected, meaning that price never came back down and broke below these structural points in the market. As these points are respected, we can label them higher lows. Now, this higher low point does not become valid until this high is broken and a higher high is created. So at this point in time, as soon as this breaks and creates a higher high, we can then label this point here a valid lower low. Now with a bearish market, we're essentially going to have the same thing just flipped and reversed. So we have a point here, 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 and here. These points above, we have a lower low where structure violates and breaks down, creating a new lower low and a lower low, lower low, lower low. These points, they're not higher highs because we are creating, you guessed it, lower highs. A lower high. A lower high, because price never came back up and violated these points to create a higher structural point. This is subjective, how you determine when a trend is valid or not. Some traders will have they'll say, after you have 3 confirmed points. So here's 1, 2, 3. They would say after this point here, they consider it a valid bullish trend. Some say 4. They need 4 for the confirmation. Some even say 5. It really comes down to your trading style and your perspective on the market, and a lot of it has to do with the time frame that you're utilizing. This here would be your bullish trend as it moves up, and this your bearish trend as it moves down, consecutively creating lower highs, lower lows, lower highs, lower lows, working its way down. Your bullish trend creating higher highs, higher lows, higher highs, higher lows, breaking market structure, and then on the bearish trend, we have our break of structure here, 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 and so on and so forth. That should give you a pretty good idea on trends. Now we're going to move on to swing points. Swing points are a little bit tricky because, again, it's one of those things where traders are going to have different opinions based on experience. Now, for me and how I trade and what served me the best in my experience, here's a very crude depiction of 3 candles. It doesn't matter the time frame, any time frame, because what we're going to examine here is what makes a valid swing point for me in my trading. And I have to give credit to ICT because this falls under his category of teachings that I learned from. So what I'm looking for is this point right here. And the reason why this point is valid is because we have a wick that has to the left of it a lower wick and to the right of it a lower wick, here and here. So this point, expand it forward in time, this becomes my swing high. And the important thing to understand is that when you're looking at market structure and you're identifying your valid swing highs and swing lows, if this were a swing low, it would be the same thing, just reversed. And it doesn't matter where the bodies close at. You could have something that looks like this. As long as we have this wick here with a higher wick to the right and a higher wick to the left, that would be my valid swing low point. Pretty simple concept. When you start getting into the charts and the candles and the print, you'll really want to practice this and develop a retinal memory for identifying this. Because when price is printing, especially if you're a low time frame trader like me, you have to be able to identify these swing points quickly and accurately so that you can adjust with the ebbs and flows of the market. So that covers swing points. Next, we're going to talk about top-down analysis and the importance of this. You should by now understand that charts have different time frames. You have your high time frames, which would be considered monthly, weekly, daily, maybe even 4-hour. And then you have your lower time frames, which are your hour, 30-minute, 15-minute, 5-minute, 1-minute, 5-second chart. Doesn't matter. It's just important to understand the time chain, kind of like a food chain, right? The reason why top-down analysis is so important and how it works is because of what I call the time chain. And how the time chain comes into play is this right here. At the top, you have the monthly. When I analyze my charts, what I'm doing is I start on the monthly chart and I mark out my points of interest, which we'll cover in a later video. And then I work my way down to the weekly and then down to the daily, and from the daily down to the 4-hour, and from the 4-hour down to the 1-hour, and so on and so forth. Because what I want to see on my charts is I want to know where the monthly points of interest are, where the weekly points of interest are, and the daily points of interest, and the 4-hour points of interest. Because as I'm trading on the lower time frames, what I care about is when price is entering these high time frame zones, that's when I know, okay, I might have price flip a reversal on me here. Because if I'm trading a lower time frame and it works its way up into a point of interest that's a monthly point of interest, a weekly or a daily, I need to take that into consideration. I need to be aware of that. So again, it's very, very important, in my opinion, to run your top-down analysis. Understand where your monthly, weekly, and daily and 4-hour points are at, regardless of what you're trading, right? If you're not a low time frame trader, if you're a swing trader, then you can just vamp that up to maybe you have quarterly and then monthly and then weekly and then daily. Because of, and rolling into the last segment of this video, the fractal nature of the market, it's important to understand that the time frames are going to come into alignment with each other. I'm going to kind of tie fractal market teaching into the top-down analysis here. So let's say, going back to the trend portion of this teaching, we have price that's moving in an upward trend, blue for monthly, right? And then within the monthly trend, we're going to have market structure that is a weekly market structure. And it's going to look something like this. And this is the fractal nature of the market, so on and so forth. So within this weekly, we're going to have the daily market structure, so on and so forth. And further down in scope, within the daily, we're going to have the 4 hour and the 1 hour. So I'm not going to draw all that out because it's just going to look like a big squiggly mess right here. It's important to run your top-down analysis and understand the fractal nature of the market. Everything that happens on your monthly time frame happens on the weekly, the daily, the 4 hour, all the way down to the 1 minute and even lower. You can have a double top that forms on the monthly. That double top's going to form in every other time frame because the market has these patterns that it repeats over and over. It's fractal in nature. So by running your top-down analysis, you're able to understand what exactly is going on. And to give you an example of how that looks, when we're looking at our higher time frame, when we have our monthly price doing this, and we're coming up to right here, remember we have or so it stands right now, our higher high, because it was higher than this high. And then we have our higher low because it's higher than this low. Well, as price is approaching this point in the market here, this is a critical and important point to be at because what we're looking for is we're expecting price to break and create a higher high up here. But what if it doesn't? What if price turns right here and it creates equal highs? Well, this is going to be the beginning of a potential trend change. And we're going to cover that in another video because I want to keep this on topic for you. But this is why identifying these high time frame points right here is important because as price reaches this right here, I would drop down in time frame, down to a low time frame chart and watch what price is doing. Are we getting price that is creating on a lower time frame higher highs and higher lows? Or did we suddenly have price break and start to create lower highs and inevitably lower lows, which would be indication of a trend shift or a change of character shift in market structure, which again, we'll cover in the next video. But I hope that this explanation of top-down analysis and the fractal nature of the market explains to you and gives you some transparency on why it is so important to do this and why you want to pay attention to the time chain. Because again, remember, the higher time frames will govern the lower time frames, and you always want to be trading in alignment with your time frames. Trading with the trend, that's your friend. Counter trend trading is possible, but it's risky and it's more difficult. And we're going to cover all those things again in another video. But it's just really important before we go on for you to understand the basic concepts of how the price is delivered in the market, how to identify a trend, what swing points are so that you can mark them and understand their importance, how to run your top-down analysis so you have a clear 30,000-foot view of the market all the way down to the fractal nature of what's going on. Much love, trade safe, secure the bag, and I'll see you in the next one.